you can see my screen now, correct?
Yes. Yes.
Okay, great. So and you can stop me at any time. I'll just take you through my general process. So as far as my macro, what I keep on my screen throughout the course of the day is my core markets. So the S&P 500, NASDAQ 100, the Dow Jones, small caps to a degree. But then I want to keep treasury yields, crude oil, and the VIX. And right now, I'm most focused, obviously, on the S&P 500. But there's been a very big inverse correlation between the S&P 500 and 10-year treasury yields. And just to give you an idea, I will go to, I'll walk you right through my process, because I always want to focus on price and I want to focus on the trend. But what we're seeing right now, let's go to, we'll change this. We'll take these out. So what we're seeing right now is the S&P 500, which is the red and the black hash mark, and then 10-year US Treasury yields, which is the straight black line.
Yeah.
And what we've seen through 2022 is bond yields started to move higher.
Yep.
And as bond yields started to move higher, we can see the S&P 500 just started to come lower. Now, in the middle of June, bond yields topped out and the S&P 500 put in a bottom.
Yep.
Reversal, bond yields lower, S&P higher. But the problem was, in the middle of August, bond yields started to break out to the upside, and the S&P 500 pretty much went straight down. So the reason that I'm paying attention to bond yields right now is the S&P 500 rally failed in August because bond yields broke out to the upside.
Yep.
So what we're seeing now is, on last Friday, the Federal Reserve came out and they took a much softer stance as far as their hiking stance, and bond yields turned down from 433 right now to 393. So bond yields pulled back 40 basis points, and the S&P has been up about 200 points since then. So the first thing that I want to understand is not only what is the S&P 500 doing, but why is it doing it? And right now, the S&P 500 is basically trading the opposite of 10-year treasury yields and the US dollar.
Okay. So if you believe that bond yield is going to go down further, and dollar and bond yield have a very positive relationship, so dollar index will also go down. So is it safe to presume that S&P will recover further and go up?
I think that if bond yields continue lower, then I believe yes. And what we can see on the 10-year treasury yield, 433. And what happened last week, something happened in the FX market.
Yeah.
Especially with dollar yen.
Yeah.
And the yen broke down, and I think that the Fed and the Bank of Japan saw that this was a problem. And then the Fed, they put out an article in the Wall Street Journal. The markets rallied. Bank of Japan got involved. But I do think if bond yields continue lower, I think that it definitely should benefit the S&P 500. Now, another key thing that I'm looking at right now is the volatility index, which is the VIX. Mm-hmm. And the key level here is 30. So we can see the VIX was trending higher over the 20-day moving average. It recently broke below 30 on Monday, and now it's starting to break down. So we have really two things: bond yields moving lower, VIX moving lower below the 50-day moving average. And as a result, S&P 500 has been moving higher. So I do think, yes, if bond yields continue lower, then I think that should benefit the S&P.
All right. I'm very excited to see the moving averages which you have plotted. If I'm not wrong, it's 20, 50, 100, and 200, right?
Exactly.
And you will be, pleasantly surprised to see exactly the same template which I use, except I use 21 moving average and 55 for short term and 100,
Sure.
200. So this template looks quite similar to me. Very, very good to see. So could you explain the relevance of all these four moving average in your setup?
Yes, the relevance for me is my time frame. So the 200-day moving average for me, which is the green line, that basically gives me the primary trend. So if we have a rising 200-day moving average, and we'll take a look at a market with a rising 200-day. So this is the energy sector ETF. So what the rising 200-day signifies to me, primary uptrend. And then I'll use the 20-day and the 50-day more for entry and timing. I don't really use the 100-day too much. I keep it on there for context, but the 20-day, the 50-day, and the 200-day, those are my three key moving averages that I look at. And then I look for very, very simple things. Is the 50-day moving average rising or rolling over? Same thing with the 20-day. And ideally, I like to see all three moving averages going in the same direction, either turning up, or if they're rolling over, that tells me that's something that I want to avoid.
Okay. So when you say rising, that means you're looking at the slope of 200-day moving average. So when do you conclude that the moving average has stopped rising and the moving average is sloping down now? Then you decide that I should exit?
No, I don't exit off of the slope of the moving average. So primarily what I'll use is either a fixed moving average, like the 50-day or the 200-day, or I'll use just a fixed percentage stop. So if I take a new position, I might just run a basic 10% stop or a 12% stop based on the volatility.